Okay, so I want us to get things in perspective before we start this question. First of all, I want you to remember the bit where we said asset, capital, liability. But let me do it this way for us. So asset or expenses, right? Asset or expenses, and then we went for capital, liability, and income or revenue. Say they all behave in similar ways. So asset and expenses, when they are increasing, we debit, right? So positive, when they are increasing, we debit. So obviously, when they are decreasing, we credit. And for capital, liabilities, and income, when they are increased, we credit. I just want us to remember this. Okay, and more so, the types of account, the personal account. I hope you remember. We debit the receiver, credit the keeper. These are things you don't have to forget if you want to be successful in dealing with the double entry principle. Okay. I think so far we have been able to go through the 11 transactions I spoke about. So you have a general understanding of what to do when the owner makes investment or starts a business, when the business buys an asset, when the business acquires a loan, etc. Right? Okay. So let's look at this question. I'll do the reading myself so we can move faster. The following transactions relate to Mr. Yangson Limited for March 2008. So on the 1st of March, started business with 1,000 cedis cash. On the 5th, bought goods worth 250 cedis on credit from KK. On the 10th, contracted a loan of 500 and opened the bank account. On the 15th, bought vehicle 250 paying by check. 21st, cash purchases of 180 cedis. 26th, pay Jackie 250 cedis cash. 30th, withdrew 100 cedis for private use from the bank. And finally, 31st, bought goods on credit from Yvonne 150 cedis. You are required to show the effects on the accounting equation and then B, prepare the ledger account. So the requirement comes in two folds. We have to show the effect and then we have to prepare the ledger account. So the ledger account here means the T account, right? So let's begin. I'll try to do the effect and the ledger account for each of the transactions so that you would appreciate it better. The other way around it is for you to look at the effects before you now go and do the account. But let's do it together so you can get the understanding for both requirements. Okay. So the first thing you have to do to get your ticks when you are answering an accounting question is to indicate the name of the business. So if you see, I'll use the right side of my screen as my solution. So I guess you can get your exercise book or notebook and also get ready to write as I write. So you need to write the name of the business. And that is Mr. Nyang's. It's always important you do that. If you don't do it, you lose precious marks. Then okay. Then what are we supposed to do? The first option is option A, which says that we should look at the effects of these transactions on the accounting equation. So A. So if you want to look at the effect, you can use this table to get your answer well presented. So you have 1, 2, 3, 4 columns actually. So the first one will take the date of the transaction. The second will take the transaction itself. And then the 2 and 3 will take the effect, whether an increase or decrease. Okay. So if you see my table here, that's what I've done. I've set out the table with the transactions and the effect here. Right. Okay. If at any point you miss anything, then I don't want to leave anybody hanging. Okay. So let's pick the first transaction. Started business with 1,000 cedis cash. Professors, I think this is about the millionth time I'm looking at this transaction. So professors, what are you going to do? What effect does this have on the accounting equation? And we know the accounting equation is asset, capital, liability. So does it increase an asset? Does it decrease a liability? Or does it decrease capital? Who is going to pick this first one for me? Started business with 1,000 cedis cash. Yes, for Christabel.
There's going to be an increase in assets and increase in capital.
Exactly. Increase in asset and increase in capital. So in showing your effects, you only have to tell us that this transaction will lead to increase in asset. But here you have to give us the specific asset, right? Because the specific asset was mentioned, that was cash. So it's going to be an increase in asset cash and then a corresponding increase in capital. So this is how you write your effects, as simple as that. Okay. So we have increase in asset cash and increase in capital. So professors, you should always know that anytime the owner starts a business, right, or invest in a business, the business asset will increase and the business capital will also increase, as simple as that. Now I said that I will do the T account or the ledger account concurrently so that you can follow. So if we are to record this transaction in the T account, what it simply means is that we need to open the T account. Now you can get the account from the effects you have, the analysis you have done to get the effects, right? So as we all appreciate, the two elements here are assets, cash, and capital. So if you are to open the account, then you have open cash account and capital account. So the account you actually open is the specific element you find in the transaction. Is it an asset? If yes, what asset? Is it cash? Is it building? Is it vehicle? So in this case, in Mr. Yanka's case, it was cash. The asset was cash. So we open cash account. And the other account is going to be capital account. Now, you know that in the T account, you have to do a debit and a corresponding credit. You have to do a debit and a corresponding credit. So you can only do that, or you can successfully go through that if you remember the elements I spoke to you about. So we have seen from the effect that the asset cash is increasing. And if an asset cash is increasing, what entry do you put in the cash account, professors? Are you going to debit cash or credit cash? Yes, who is going to answer that for me? Yes, I will go.
Except it's with debit cash.
With debit cash, exactly. because cash is an asset and it's increasing. As we did the analysis up there, the cash is increasing. So we are going to debit. And if you are debiting, what you do is you come to the left side, right? The left side of the account. The first thing you put there is the date. So what date does this transaction occur? It was on the 1st of March 2008. The details, right? The details is the other account. So in this transaction, the other account was the capital. Then you put the amount there, 1,000 cedis. Now you can see that the currency cedis is always on top of the amount column. You always have to do that. If not, you are going to lose marks. For those who are confused why we are putting date here, whatever. If you open your T account, the first column is your date. The second column is your details, right, or particulars. So the details or particulars state the name of the other account, okay, and then the amount column. So that's what you normally do if you are recording your transaction in a T account. Okay. So we have debited cash. Definitely the corresponding credits will go into the capital account. So in the capital account, we come to the right side. The date is still the same, 1st March 2008. The details is going to be the other account, which is cash. Then the amount is 1,006. So what we have done here is recording in the T account or the ledger account. And you cannot agree that the double entry principle has been completed because we have debited 1,000 and there is a corresponding credit of 1,000. Okay, please, any question? Any question? Okay, so you see why it is important for you to be able to know the effect it has on the element, because if you know the effect, then you can apply the double entry principle. For example, if asset is increasing, then you debit the asset, and if capital is increasing, you credit. So it's very important you remember that. Okay, let's go to the second transaction. So let me see. The remaining transactions, I think I'll do it this way. If I call your name, you read it, and then you do your own analysis and tell us what you are seeing. Are you seeing an increase in an asset or an increase in liability, right? Okay, so let me call the first person in no particular order of Gabriel Jan. The second transaction. If for some reason you need a lawyer, you can alert me to do that. I think Gabriel will need a lawyer, so let me get a female lawyer for Gabriel, and that will be of Janet Upoku. Of Janet.
Oh, Susan.
I think somebody wants to communicate. the transaction. Okay, I think you have to read the transaction. So my screen should be showing. Okay, so Jen, take the second transaction and let's go.
Okay. Bought goods worth 250 cedis on credit from KK. So since you bought it on credit, there will be an increase in liability.
Okay.
For the account to open.
Okay, I think Jane has given us one side of it, right? So we are waiting for the other side. Because remember, the double entry says that you should have twofold effects, right? So always the minimum account you should get or element you should get in a transaction should be 2, even though we have realized that sometimes it could be 3 or more, but the minimum should be 2, right? So she has identified the liability part because she says that we bought the goods on credit, so we didn't pay. So that would bring some obligation onto the business. So that will be the liability, right? So Jane, if you are ready to give the other side, yes.
So there will be an increase in assets.
Increase in asset. What specific asset are we talking about?
The goods.
The goods or the stock. Thank you very much. Thank you very much, Jane. I appreciate your contribution. So professors, I think we all agree that you should always see yourself as the business because you are recording the transaction for the business. So I always tell my students, see yourself as the business. So you, the business, you have gone to buy goods, 250 cedis on credit. So what is going to happen? Number one, you are going to get goods, and that is stock. And we know goods or stock to be assets. So since you, the business, you are getting goods or stock, your assets will increase, right? But you also acknowledge that you didn't pay. You bought it on credit. On credit means you didn't make any payment. If you didn't make any payment, it means you owe the person. Who is this person? KK. And in accounting, if you buy goods from an individual or a firm and you don't pay, that person becomes your creditor. And a creditor is a liability. So that is why Jane told us that there will be an increase in liability and increase in asset stock. Okay. Please, if you have any question on this one, you can ask me. Okay, so now let's go and put in the effect. So the effect will be increase in assets, and this specific asset is stock, right? In place of goods, we use stock. So if you write goods here, you might lose marks. So increase in asset stock, and then increase in liability. And that will be a creditor, right? Because KK becomes a creditor. So creditor, you can add the name KK to it. So professors, anytime you see that a business is buying goods on credit, okay, the transactions don't change. It's just the name and the date and the amount. Okay, but the main transactions do not change. You are always going to have credit purchases or when the business buy goods on credit. So anytime you see such a transaction, remember, there will be an increase in the asset stock of goods, right? And there will be an increase in what? Liability creditor. Okay. So if you are to prepare the T account, then the two accounts will be the creditor KK, right? So KK's account, and then the asset stock. But remember, I told you that we don't open stock account in accounting, right? At least for our curriculum. Let me put it that way. In other jurisdictions, they will open the stock account, but in our case, no, we will not open stock account. We would open purchases account anytime there is increase in asset stock, or anytime you buy goods, bought goods, purchase goods, you open the purchases account for the stock. So the two accounts here will be purchases and then the creditor. So we open purchases account. So if you open stock account, that will be marked down, right? Because anytime you buy goods or you buy stock, open the purchases account instead of stock account. The same way when you sell goods, you open the sales account. So get this summaries and you are good to go. Then we open KK's account, KK. So you can add more to KK's account and let us know that KK is what? A creditor, right? So which account are we going to debit and which account are we going to credit based on the effects that we have just written? So the effects are increase in asset stock, and the account we are opening here is purchases, and increase in liability creditor, KK, right? So which of them are we going to debit and which of them are we going to credit? I think a professor should do this for us. Christabel has spoken, David, Gabriel has spoken, Jane has spoken, Josiah. So Josiah, probably, please let me know if your silence is communicating, misunderstanding, right? Let me know. Don't worry about that. Because the more I explain for you, the more you get the understanding, right? So let me call on Jorish. So Josiah is hiring Jorish as a lawyer, but I have Fidel and Jane ready to answer. So Jorish, that's it.
Yes, sir. Please, you credit KK accounts and
Uh-huh.
then you debit your purchases account.
Exactly. Thank you very much. So we have seen here increase in liability. So anytime a liability is increasing, what do? You credit. What account are you going to credit? KK, right? You see here increase in asset. So you are supposed to debit. But what account are you going to debit as we have analyzed? Purchases. So thank you very much, Jorish, for that. My professors who are not responding to me and talking, please, I hope you are not confused. If you are confused, let's sort it out before it is too late. Okay. So in the purchases account, we are going to do what? Debit. So we are going to put the entry at the left side. The date is 5th March 2008. The details will be the other account, right? Which is the KK, right? KK account. Then we put the amount there, which is 250. Then we go to KK's account on the credits, which is the right side. The date will be the same, 5th March 2008. The narration will be what? Purchases. And we put the amount there, 250. That's all. So purposes, anytime you see bought goods on credit, right? Then you have purchases and then the creditor, right? Okay, let's go to the 10th March transaction. So let me call on between Emmanuel and Nicole. Okay, ladies first. So, okay, Prof. Fidel, you have a question or you want to attempt that one?
Service, I want to answer the question.
Okay, so go ahead. Yeah, Fidel, go ahead.
Okay, service for the contracted the loan of 500 CDs and open the bank account. Increase in liability, which is the loan.
Okay.
The increase in assets, the bank.
Okay. Thank you very much, Fidel. Is there anybody or any professor who has a different interpretation? So according to Fidel, the business is going for a loan or contracting a loan, and a loan is a liability, right? And this loan was put in a bank account. They opened the bank account and put it there. We know also that the money you have in a bank account is an asset. So bank is an asset. So we have a liability loan and an asset bank. And he has indicated that the loan liability will increase. Likewise, the asset bank will also increase. If you disagree or you have another opinion, please let me know. If not, then we'll take the gospel according to Fidel as the true gospel. Let's go to our table and put in the effects. So anytime a business goes for a loan or contracts a loan, Professor says there is always increase in liability loan. And this loan was put in a bank account, and a bank is an asset, right? The money we have in our bank account is an asset. So there's increase in assets, and that is what bank. If the loan came in the form of cash, then there would have been an increase in assets, what? Cash. So note this one. So here we are going to debit who? Bank, and we are going to credit what? Loan. We are debiting bank because there's an increase in that asset bank. And we are going to credit liability because there's that increase in liability what? Loan. I think I can put the principle here so that professors will not get confused. So we say when assets when they increase, right? What do? You debit. And when capital liability, when they increase, credits. So you always need to remember this principle. Right? Okay. So we go into our T account and look for loan and bank account. So if we go to the ones we have opened, there's no loan, there's no bank account. So we need to open fresh bank account and loan account. Okay. So we are going to debit the bank. The left side, we put the date, that's 10 March 2008. The details will be the other account, which is loan, and then we put the amount there, 500. Correspondingly, we come into the loan account, put the date 10th March 2008. Then details will be bank, and the amount is 500. Simple as that. Okay. Is any questions so far? No questions. My professors are good. We go to the 15th transaction, then Prof. Manuel Nati, you do that for me. 15th, bought vehicle, 250, paying by check. Bought vehicle.
Okay, please, on the 15th, bought vehicle 250 to be paying by check. So one asset will increase and the other asset will decrease.
Okay, so can you give the specific asset that is increasing and the other specific asset that is decreasing?
So the vehicle will increase and the bank will decrease.
Thank you. Thank you. That is very true. So, professors, the business, right? So, like I said, use yourself as the business always. You, the business, you are going to buy a vehicle and you paid by check. Now, anytime you see check in a transaction, we are referring to the bank, right? The bank account. So, you see that you, the business, you'll be getting a vehicle. So, an asset vehicle will increase. And because you paid with a check, it means you remove money from your bank account. Your bank account will reduce or decrease. And bank is an asset, right? So his analysis is true because there will be increase. So this will lead to an increase in asset, which is vehicle, and a corresponding decrease in asset bank. So you see that I'm always putting the specific items in brackets. It's very important. So here the two accounts you open will be vehicle and what bank account. But mind you, we already have bank accounts opened, right? So if you already have an account open, you don't need to go and open it again. So we already have bank account open here. So we're not going to open another bank account. But for the vehicle, we don't have the vehicle. So we open the vehicle account. Okay. So we saw that we have to credit bank because we are paying. So that will be 15th March 2008. In the name of vehicle, the amount is 250. Then we'll go and open the vehicle account. So please be very careful. The point I just made. Some students, you see their answers and they have like 5 bank accounts, different. No, you only open one account when you are recording transactions. So we are going to debit the vehicle, which means on the left side. So we put the date, which is 15th March 2008. The narration will be bank, right? And we put the amount there, 250. Please, some students have been opening check account. I beg you, there's nothing like check account. Check is bank. 21st transaction, and I think Nicole will do that for me. 21st transaction, cash purchases. As Nicole is preparing to do that, Prof. Ewenam, get ready for the next one, and Prof. Stacy, yourself, and then the last two probably be done by Michael Boateng and Joshua Boateng. So let's get ready. So Prof. Nicole, 21st March, what happened and what can you tell us?
Okay, 21st March, cash purchases of 180 cedis. So there'll be an increase in assets, that's the stock, and then a decrease in assets, that's the cash.
Thank you very much. That was a smooth one, a very smooth delivery. So let's go into our table and write the effects. So of course, if a business, you go out and you go and purchase goods and you paid cash. So increase in assets, that's the stock. Then there will be decrease. Assets, cash. right? Cash purchases means you are going to buy goods with cash. Even though there's no mention of goods, anytime you see cash purchases, okay, it's goods they are referring to. Okay, so an asset stock is increasing, and we have just established that anytime stock is increasing, we open the purchase account. In other words, from the transaction, cash purchases. So you open purchase account and then the cash account, right? So we are going to debit purchases and credit cash. Already we have the purchase account, so you don't need to go and open a new purchase account. Just the old one, go and put in the transaction, which will be on the left side or the debit side, 21st March 2008. The narration will be cash because that's the other account, 180. Then you now locate your cash account. I think we already have a cash account. Yes, here it is. This time we credit cash. So on the right side, 21st March 2008, that will be purchases. The amount is 180. Very smooth. Very smooth. I'm really enjoying the class. Okay, so Prof. Ewena, the ball is in your court now. 26th transaction. Let's go.
Okay, the 26th transaction. Pay Jackie 250 Ghana cedis cash. So it will be decrease in liability, decrease in cash.
Okay, so decrease in liability and decrease in cash, which is an asset, right? So decrease in asset cash. Great. Awesome. You see, I'm happy. I'm a happy man. I don't even know what to say. Yeah. Mama meeting I'm the oh my God. Yes, I will go.
Sir, please, I got disconnected, so I didn't get some of the things that he said. So please, whatever I said, no, please, can you repeat?
I will go. If I'm to repeat all the things I've said, I think that we'll end the class tomorrow. So you know what? Don't worry, you'll get the understanding as we are advancing. But like I shared the video, you can always play back the video and get those comments. But I don't know where you got lost. If it is one that I can quickly, which transaction did you get lost?
Sir, please, the one that speaks about the vehicle.
Okay, you bought a vehicle, right?
Yes, please.
So what would have been your analysis of that transaction? The business bought a vehicle paying by check.
Increase in assets, the vehicle, then decrease in assets, the bank.
We don't have a problem. That is okay. You are good to go.
Okay.
Great. So let's move on, right? So we're on the 26th transaction. Pay Jackie 250 cash. Now, we are convinced with the asset cash, right? But the Jackie, how did Safam know that Jackie is a liability or a creditor? The assumption is simple. Why would you make payment to somebody? It is only when you owe the person, right? That is why Jackie is seen as a creditor, because creditors are the people we owe as a business. So if you are making a payment to someone, it means that person is a creditor. That's why you are making the payment to. Okay. So let's go and put in the effects. So if we have, okay, so I think that, okay, so that's an error here. This should have been KK and not Jackie, right? So let me do the correction. KK. So it now makes sense that KK was the person we bought goods and didn't pay. So we owed KK, right? Great. It makes sense. But if in the question it was Jackie, or if we're solving a question it was Jackie, you don't see that Jackie is somebody you still go ahead and do that. It will be correct. Okay. So please take note of the correction. It should be pay KK 250 cash. So KK is already a creditor, right? We bought goods on the 5th from him without paying. So that will be a decrease in liability. That's a creditor KK. And there will be a decrease in assets. In assets, cash. Okay. So that would have been the effect. So in terms of the account, you open cash account and KK account. KK is a liability and it is decreasing. It is decreasing because we are making payment to him, right? So if a liability is decreasing, right, what will be the entry? A debit. Because if it's increasing, we credit. So if it's decreasing, we are going to do debit. So we go to KK's account. We already have KK's account, so we don't need to open it, right? Then we debit KK. The date is 26th March 2008. We paid KK with cash, so the narration will be cash 250. And then we'll go to cash account. We already have our cash account, yes. We credit cash, right? So on the right hand side of cash, March 2008, the narration will be KK. That was the person who received the cash, 250. Now you see, if you are using the personal account to do the analysis here, KK is a person, right? And we paid the cash to KK. So KK was receiving. So debit the receiver. And that's how come we debited who? KK. So you can use, but I prefer using the asset, capital, liability, expense, income, because the types of account may be confusing sometimes, right? But it's very easier when it's related to personal account, right? Okay. So who was going to do the next one? 30th. I think 30th. That should be, yes, Abako, hold on. 30th should be.
Sir, please, can you take, sir, please, can you take the last two transactions again? The 21st and 22nd.
There is no 22nd. We only have 21st. And we just finished with 26.
21st and 26th.
We just finished 26. I don't know if again we lost you.
Yes, please. Yes, please.
Okay, so tell us, what do you think about these two transactions?
So the 21st, what I wrote in the work was, I just wrote decrease in assets because I didn't see any other thing. I just wrote decrease in assets.
Which one? The
21st.
You saw decrease in asset. What asset was decreasing?
No, I just wrote decrease in assets.
So yes, there was a decrease in asset, but what asset?
The cash.
Okay, so if cash was decreasing, what is the other effect? Because you know the minimum effect should be 2.
Maybe you are buying something.
So anytime you see cash purchases, it means you are buying goods or stock with cash. Okay. So even though you don't see cash purchase of goods, it's the same as cash purchase of goods, right? So you got the other side correct. That is the decrease in asset cash. The other side would have been increase in asset stock, because when you purchase, you are getting goods, right? So the asset stock goods will increase. So I think that's something.
The purchase account.
Yes, so you open purchase account and cash account.
Okay. And then the other one.
So the other one, let's hear you.
That one I wrote decrease in assets. That's the cash. And then the decrease in liability. That's the KK.
Exactly. So that one you have no issues there. That's the right thing to do.
So the double entry, it will be which one? You credit the KK.
You just said KK's there will be decrease in liability KK. So if a liability is decreasing, do you credit? You rather debit, so you debit KK.
Okay.
And you credit cash.
Okay, thank you, sir.
Okay. Professor Aboko is trying to get everything. He doesn't want to miss every point. That is good. Okay. And I think his question sometimes, helps some of us to also get a repetition of the core point. So I appreciate that. But when it gets too much, I'll cut him off and I'll tell him, please, your network, you have the how does MTN say you have 2 minutes remaining? Okay, so let's go to 26. I think 30th. 30th was to be done by the person has done me juju. I don't remember the person. Was it Ewenam or Michael? What? Okay, Michael, please do that for us, okay? That transaction is withdraw 100 cedis for private use from the bank.
Sir, please, it will be asset, a decrease in assets. Decrease in assets.
Wow, you got the decrease in assets correct, but in fact, you got the other decrease correct. But the item you are seeing would decrease. So you have decrease in asset and decrease in asset. The decreases are correct in both cases, but the other thing is not an asset. It is something else. Oh, if you can get that one, like I'll jump into the skies and come and fall down. But that was a great attempt. Okay. Let me see. So who is going to give us the other one? Joshua Boateng. Yes. No, Aweko, hold on, please. This is not for you, Aweko. Hold on. Let me get Joshua Boateng to save Michael Boateng. They are all Boatengs. So Joshua.
Okay.
So please the question again.
So we are looking at the 30th transaction and the effect it will have on the accounting equation.
Okay, sir. So it will be assets. That's bank.
And
then you say the 30th?
Yes, the 30th.
Oh, sorry. It should be decrease in assets rather. It's like a bank. And then decrease in capital.
Thank you. Decrease in capital. So that was the point Michael makes. So there's decrease in assets and another decrease, not in another asset, but capital. But what specific account do we open for this one when the owner takes something for private use? I remember hitting on that in the last time. What account do we open? Or what name do we give to that? Abuko, I won't call you. I'm telling MTN to cut your network. Oh, but I want somebody to answer that for me. Who? Let me see. Oh, today. Okay, Dennis Leafhaven. Whenever the owner takes something for personal use or private use, we have a unique name for it. What is that? Dennis, if you answer this correctly, I will never call you to answer any question until the end of this class. Or you want to get a lawyer? I think majority of you know it. So please, all those who know, unmute and tell me the answer. What is that?
Drawings.
Drawings. Exactly, drawings. Oh, so it means my professors are learning. Oh, that's nice. I'm happy. I don't know, but it seems like Dennis does. Dennis is not a talkative on Pekasasa, but we'll force him to talk. So, Prof. Dennis, prepare yourself. You talk, sir. Run away. Okay, so that is drawings. So let's go to the effect quickly and put it down. So I hope, Michael, you have been able to determine the other account that's the capital, right? So there will be the capital. So decrease in asset bank, right? Because the owner took the money from the bank account, right? So decrease in asset bank and decrease in capital, and specifically drawings, because anytime the owner takes anything for private use, it constitutes drawings, and that decreases capital. So here the two accounts you are going to open will be bank account and what? Drawings account. Bank account and drawings account. So what you are going to do is to debit drawings, because you know when capital is decreasing, we debit, right? When capital increase, you credit. So when it decreases, you debit. That's why we are debiting the drawings. And then the asset account bank will be what? Credited. So let's go and do that. So we have to open drawings account. We don't have drawings account, but we already have bank. So let's go to the bank account first. And in the bank account, we are supposed to credit, right? So that will be 30th March 2008. The name will be drawings 100. Then we'll go to open drawings account. Since we don't have drawings account, we need to open it fresh. So let me copy this account and use it as mine. So drawings account. You see that it's the thing is very sweet and simple if you really understand the principle and you are doing the thing JJ without any problem. So we debit drawings 30th March 2008. That will be bank 100. Very simple. Very simple. We are left with the last transaction. And, will David do this for us? Nicole, is that a question for us?
Yes, please.
Okay.
So please, what happens when the owner takes like goods from inventory instead of money or check? They take goods for their personal use.
Okay, so just apply the same principle. The owner is taking what? Goods or stock. So there will be decrease in asset stock, right? And there will be decrease in capital in the form of drawings. Now, in terms of the account, you are going to debit your drawings as usual, but this time you credit purchases, because when you buy the stock, you put it in purchase account. So if the owner is taking something out, you credit it. So you credit your purchase account. But most of the times, what happens? Okay. So I said that with the effect, it's going to be decrease in asset stock. Do you get that part? Because the owner is taking stock away from the business. So the business stock would decrease. So asset stock would decrease. Are you okay with that one?
Yes.
Great. And because it's using it for personal use, that is drawings. So drawings is going to decrease the capital. So we have decrease in asset stock and then decrease in capital drawings. But in terms of the double entry, we would debit drawings. Anytime there's drawings, you debit drawings because there's a decrease in capital, which expects that you debit the account drawings. The credit entry is done in the purchase account. Okay, because your purchase account keeps the stock or the goods. That's why when you go and buy the goods, you open purchase account and debit it. So if the owner takes away some of those goods, you credit it. But most of the times, what happens is we wait till the end of the year and see how much goods the owner has taken, and then we adjust it from the purchases in our trading account. It will make a lot of sense when you get to sole proprietorship final account, when you are preparing trading account. But for now, what I can say is that it should be deducted from what purchases. So you credit your purchases account. Okay.
Okay, sir.
Thank you. So I think the last one, Prof. David Nyampong. Please, between yourself and Araba Yabua, whoever is ready to deal with that. Bought goods on credit from Evans. In fact, let me add S to make it Evans. So bought goods on credit from Evans. Prof. David Yam. Or Prof, you want Araba to be your lawyer? Okay, Prof. Araba, I think David wants you to be. But David, let's hear from you if you really want Araba to be your lawyer, or you are still processing and analyzing the concepts. Oh, David, now you kill Goliath now. What are you doing? Let's hear from you. Or you are not the one. So the 31st transaction is a Goliath. Please kill it for us. Oh, Prof. Araba, the lawyer. Prof. David, let's hear you.
Okay.
Yes. I want you to analyze the 31st transaction, bought goods on credits from Evans. So what is going to happen? Will there be an increase in asset or increase in liability or what?
So please, there's going to be an increase in assets. And there's also going to be a decrease in assets because his cash is going to reduce.
Okay, but here there's no cash. We said bought goods on credit from Evans. We bought it on credit, so it means we didn't pay.
Okay. So to be increasing liability.
Exactly. David, you have killed Goliath. David. Oh, David, there was a song they were singing for you, but I can't remember. That is great. So we bought goods on credits from Evans. So our asset stock will increase, like he said, and a liability, which is a creditor, Evans, will increase. David. And that's why in the Bible, when you went back to Israel, they gave you, the women were singing for you. That David, you have done well. Today, it is not women singing for you. It's Mr. Amwa singing for you. David, why are you money? You have done the job. Agbeku, are you there? Okay. So don't worry. Today we are singing for David. Next time we'll sing for you too. So we have increase in asset stock. This is so because we bought goods, and anytime you buy goods, your stock asset will increase. And here we didn't pay, it was on credit. So there will be another increase in liability. And that is a creditor, Evans. So Evans, a creditor. Great. So the two accounts you have to prepare, remember, if you buy goods, or if there's increase in stock, purchases. And then we open the creditor Evans account, Evans. So here we are going to debit purchases as usual and credit Evans. So this is our purchases account. We put in the date, 31st March 2008. My purchase account is so 31st. Oh, I think it's the end of the. Okay, let me shift it up a bit. 30. Oh, okay, sorry. My keyboard was not responding. Oh, because I sang for David now. 31st March 2008. So in the purchase account, we debit, and that'll be Evans. And then the amount is 150. Then it seems we don't have Evans account, so we have to go and open Evans account, right? So let me go and open Evans account. So let me get Evans account here, and that'll be the last account we are going to open, right? So Evans. So you see that it's really simple. If you remember the principle, do the analysis, get the elements, okay, and know what is increasing and what is decreasing. But always remember that you need two, minimum of two. So if you get one side and you are not getting the other side, it means you have to do more of the, the analysis. So here we have to credit Evans 31st March 2008. That'll be purchases. The amount is 150. So this is what I was expecting you to do for me in the assignment. I don't know, but I want to believe strongly that majority of you did well, right? So this would have been your effects. So regarding the effect, this is what I'm expecting to see: increase in asset, increase in liability for each of these transactions, right? If you didn't go the tabular way, you could have written the transaction and then under it, you write increase in asset, increase in capital. That way, doesn't matter. And the T account or the ledger account, this is how it is supposed to look like, right? You open your T account and then you do your debits and credits. Please, how many of us here didn't understand anything, or if you have questions? Okay, Abeko has a question. Prof. Abeko, let's hear you.
Sir, please, the assignment, I didn't draw the T account.
And so if you didn't do,
and I was writing the debit and the credit.
So the debit and credits, unfortunately, is not the T account. So it means you lose marks plenty. And I'll deduct the marks with joy.
Oh.
So the requirement says open the T account or the ledger account. So if you just wrote debit, cash, credits, that was you stating the double entry. You are not preparing the account, right? So maybe I'll give you half.
Say you should.
Okay, so Abeko. Apart from Abeko, is there any other question? Abeko, don't worry. When I mark, you know your score. Yes, Nico.
Say you should do it the way we understand.
Sir, please, what happens when the business owner pays the employee?
Okay, when the business owner pays employees with his or her personal funds or funds from the business.
maybe funds from the business.
Okay,
Or
if
like
it's a
salary.
okay. So let me put that transaction there so that other professors can follow. I wish we could solve another example, but it seems the time. So let me take questions, okay? Let me take questions. So if you are confused, this is the point where you bring your questions so that we can look at it. But let me see if I can give you a general view of how the accounts are going to look like, all of them. So it's becoming too smallish. But I think you appreciate how the accounts are going to be. So in your exercise book, when you are given the questions, you can weigh to see how many times an item is appearing, so that when you open the T account, you know how many lines to draw or leave. Okay, so before I answer Nicole's question, this question, for example, you have started business with cash. Okay, so that's capital and cash, bought goods, purchases on credit, right? So you can go through and see cash is here, cash is here, right? So cash is appearing like 1, 2, 3. So if you draw and you leave like 5 lines, that can accommodate you. Then you see bought goods, that's purchases. Let's see if you see another bought goods. Yes, that's like twice. But you also see another cash purchases, which is same as bought goods for cash. So 3. So that 1, 2, if you leave like 5 or 6 lines, it's okay. So that's how you go through the question to look at the frequency with which an item is occurring. And then you leave the appropriate lines for it. Now, Prof. Nicole's question is, where, in fact, if the owner is paying salary with the business money, it's the same as the business paying workers' salary, right? So I'll look at the other side to where the owner is paying the salary from his personal funds. So let me put some transaction there. Let's say on the 1st of June 2008. I'll make it bigger, so don't worry. And please follow it carefully, because I'll be happy if professors can do the analysis and tell me the document based on the knowledge they've had. So let's say 1st June 2008, the owner paid salary of $60 from his personal account. That's number 1. Okay, and then we have let me even remove the personal account. In as much as is the owner making the payment, it means that the owner is using his private money to pay. Then we have another one, let's say 2nd June 2008, paid employee salary, let's say $60. These are 2 different transactions, right? Anytime you see the owner is making payment, then it means the payment is not being done by the business, because if the business that is doing the payment, then you see the second type of transaction, paid employee, right? Salary of $60. Now, let's look at the first one. If the owner is paying the salary of workers of the business, it's very simple. What is going to happen? Remember, salary is an expense. That is why last time I took you through the long journey of appreciating, let me do it here again, of appreciating the effect expenses and income have on what capital. But that will be your basis for knowing the effect. So if you remember, I drew the equation and said asset equals capital plus what? Liabilities. And then I took the capital and made you understand that income and expenses affect what? Capital, because they ultimately determine profit or loss of a business. And if a business is making profit, the capital will increase. So if something increases profit, then indirectly or directly, it also increases what? Capital. And you all agree, if the income of the business is increasing, it means the profit will increase. So capital will also increase. So income increases capital. The opposite is for expenses. because expenses are costs, and cost decreases profit. So if cost is decreasing profit, then it will also decrease capital. So expenses will decrease capital. So anytime you see payment of an expense, one of the effects will be a decrease in capital by virtue of that expense. So having said this, here the owner paid salary. What is salary? Salary is an expense. So this will mean there's a decrease in capital because expenses affect what? Capital, or decreases capital. So decrease in capital, that is salary, which we know to be what? An expense. I'm adding the expense for you to appreciate that salary is an expense. Okay. The other effect is, who is doing the payment? The owner. So technically, the owner is giving the business something. And anytime the owner is giving something to the business or investing something in the business, we acknowledge what? Capital. So this will be an increase in capital. It's more or less like the owner investing money, and this money has been used to pay salary. That is what this transaction means. So the effect will be decrease in capital, which is the salary expense, and also what? Increase in capital. It sounds weird, but technically that is it. If you are wondering why increase in capital and decrease in capital, it can happen that way, like other transactions where we see increase in asset and a decrease in another asset. Okay, but if you look at the second transaction, where you see paid employee salary 60, so here there's no mention of the owner, right? I will go, hold on, let me finish the explanation, then you can bring up your question. Paid employee salary, right? 60 cedis. Then this time, still the business is paying salary expense, so there will be decrease in capital, that is in the form of the salary expense. But the other thing is, what did we use to pay the salary? Here, there is no mention of cash or check. In such an instance, the best assumption is it was paid in cash. Because if you paid somebody $60 and you didn't mention check, obviously it's cash. So this will be decrease in asset or cash. So anytime you see that they paid money and they didn't mention check, it means it's cash, right? So get that point to well noted. So, Prof. Nicole, this is how either of the two transactions will be. I've seen one question where the owner paid the loan of the business, right? The owner paid a loan of the business. And we know that the loan is a liability, and this time it's the owner who is paying that loan of the business. So you see that the loan liability will decrease, so there will be decrease in liability loan. But we also acknowledge that it was the owner who paid. So in a way, the owner was giving the business money for the payment of the business loan. So we acknowledge that as the owner investing in the business and acknowledge increase in capital. Okay. So I will let me hear a question.
I wanted to ask, the increase in capital, is it that the money that the owner pays the people in the company, some gets back into the business, or like, I don't understand that, please.
Okay, so you see, in the world of business, the owner technically is not the same as the business. So if you are you set up a business, the two of you are different. It is not expected that people see you as the business or see the business as you. That is why anything you give to the business, we acknowledge it as capital. And anything you take away from the business, we acknowledge it as what? Drawings. So we really want to measure the things that you, the owner, you are giving to the business and also taking away from what? The business. So on that basis, anytime you see a transaction where the owner is seen to be giving something to the business, then you have to acknowledge capital. And obviously that will be an increase in what? Capital. But if you look at this transaction, the owner invested some amount of money, but that money was used directly to pay for an expense. That's the salary. So we will acknowledge that, okay, the owner has made investment increase in capital, but that money was used to pay for what? Salary, expense, right? And when we pay expenses, they decrease what? Capital. I think you would have to take time and go over these things I'm saying again for you to get it. And I'm sure you definitely appreciate it. So, Prof. Nico, I don't know if you are now convinced.
Yes, please. So when you're joining the T account, do you write salary account or expense account?
Yes. So in this first scenario, the two accounts will be capital and what? Salary. So you are going to debit salary. We are debiting salary because there's a decrease in capital, right? And when capital decreases, we debit. So you debit salary and you credit who? Capital. That is going to be the double entry. You debit salary, you credit capital. So if I'm to open the account here, rough work, let me do that rough work here. So we would have opened capital account. So let me use C for capital and we open what? Salary, right? So S for salary. So we would have debited salary in the name of capital, right? $60, and we would have credited capital in the name of what? Salary, $60. When somebody picks this transaction, the understanding the accountant will get is that, okay, the business paid some salaries, but it came from the owner. It was the owner who made that payment of salary. You get the point?
Yes, please.
Okay. Abeko, do you still have some confusions for me to clear?
Sir, please, small will go.
Don't worry, small will get there, like you have just stated. Christabel, David, Dennis, Emmanuel, Fifi, Fidel, Janet, Joris, Joshua, Josiah, Michael, Nicole, Ewena. If you still have issues, let me know. If not, I think we'll draw the curtains here. I'll share the video so that you can watch this particular lesson over and over again. Yes, Prof. Nicole.
Sir, please, since there's more time, can you teach us the balancing of accounts?
Yes, so the balancing of account, yes. It is something very easy to do. If there are no questions here, then I think I can spare some 5-10 minutes to clear that. Okay. Okay, so let's get to. So professors, normally when you are done preparing your T account like this, it doesn't end there. You have to go and balance the account. So this T account that we have drawn here, we have to balance it and extract a trial balance. I would have wished to teach that in my next lesson, because then I'll do the balancing and then extraction of the trial balance. But I think we can do the balancing so that you can try your hands on. But my time, would it permit me? I think I have like 10 minutes to go. Okay, let me see what I can do. Or maybe I'll give you the steps and then you see if you can commit it to memory. Then the next time we do the practical balancing of account. But for now, I think majority of you should focus on solving more questions. So I have this textbook. I'll try and screenshot some of the questions for you on the page. Try as many as you can, right? And you Of course, you can put it on your private page. I'll check it and mark for you. I'll be glad if all of you commit to solving more questions. Okay, so let me go to the balance. Means that, okay, you know, an account has two sides, debit and credit. Now, depending on the entries you make, my screen went off. Yes. So let's end the class here. Don't worry, I'll do the balancing of account and extracting the trial balance. And then maybe we can solve 2 additional questions on this T account. Okay. So that we can be very comfortable. And then, so that should be tomorrow, God willing, you'll be writing you'll be writing your tests, right, for tomorrow. So hopefully next week, that will be Tuesday. Oh, sorry, Wednesday. We can do the balancing of account, and then probably Thursday solve 1 or 2 more questions. And I think it will be good to clear up this double entry and trial balance. Okay. So Prof. Nicole, pardon me, I may have to postpone the balancing of account because there are certain things I need to explain on that. Okay. And the time will not permit me. Okay.
Okay, sir.
Thanks for understanding. So profs, I'll share like some 2 similar questions on the page. Try and solve it. Do the analysis. What is happening? Is it increasing or decreasing? Okay. And where you are confused, you can even put it on the page. We can do audios to discuss them. Okay. Learning should not be only when we meet in class. On the page, if you are confused about something, you can do an audio or you can type something there. I'll respond when I see it. Okay. So, Mr. Amwa, I'll leave you here today. At least we have solved 1 question and you have appreciated how the double entry principle is used in recording transactions in the ledger account, as well as the effects that these transactions have on the accounting equation. Those who have not or who didn't submit the assignment, I don't know if you go and try it again and submit, since we have solved it together in class. But you don't have the solution. So I'm only giving you a second trial to go and do it and submit. Okay, because now you fully understand. Yes, so that's all. I'll see you another time. And I wish you all the best in tomorrow's test. I'll put every detail on the page for your page. Thank you very much, Professor. Au revoir.